we need to talk about alchemy.
Alchemy, okay. You mean like the old medieval pseudoscience?
Exactly. People in robes, dusty labs trying to turn lead into gold.
Right.
But I'm not talking about that kind. Not the potions and wizards kind. I'm talking about modern alchemy.
Okay.
The kind that happens in a glass office in Manhattan, 50 stories up. The kind where you take a pile of absolute garbage, loans that are never, ever going to be paid back, and you wave a mathematical wand over them, and suddenly
They're gold.
they're gold. They are AAA-rated. They are, on paper, the safest investment in the entire world.
And then inevitably the spell breaks.
And the world blows up. Welcome to the Deep Dive. Today, we are tackling the villain of the 2008 story, the smoking gun. The three letters that just keep coming up in every single documentary, every book, every lawsuit.
Every angry conversation about the financial crisis.
The CDO, the Collateralized Debt Obligation. Warren Buffett didn't mince words about these things. He famously called derivatives like these financial weapons of mass destruction.
He did. And it's a phrase that gets quoted all the time.
And usually when people use phrases like that, they're being dramatic, right, for headlines. But in this case, looking at the source material we have, the Financial Crisis Inquiry Report, the really deep investigative work from journalists like Michael Lewis, Bethany McLean, he was barely scratching the surface.
It is the defining acronym of a decade. But what's so fascinating, I think, is that the reputation, that villain status, it often obscures what the thing actually is.
Totally.
It's so easy to just call it a weapon. It is so much harder to understand the mechanics of why it was built in the first place.
And that is our mission today. We're going to move past the buzzwords. We're going to ignore the stigma for a minute and just look at the mechanics because, and this is where it gets really interesting, this wasn't designed to destroy the economy.
No, not at all. It was designed to manage risk.
To manage risk.
Precisely. It was a genuine attempt to use math and financial structure to make investing safer, more efficient. And the tragedy, or maybe the irony, is how a tool designed to disperse risk ended up concentrating it.
Concentrating it to the point of, well, systemic failure.
Global systemic failure.
It really is a story about alchemy. We have these documents, and they all paint this picture of bankers, rating agencies, investors, all sort of holding hands and agreeing to believe in a fantasy because the money was just too good.
It's a story about incentives. It's a story about a blind faith in models. And maybe most importantly, it's about what happens when you completely separate the person lending the money from the person who's actually taking the risk.
Okay, so let's start at the very bottom. Before we get into the crash and the drama, we have to define the beast. If you're listening and you've heard CDO 1,000 times but never really looked under the hood, what, in the most basic sense, is a collateralized debt obligation.
Okay. At its heart, a CDO is a type of what's called a structured asset-backed security. Now, that sounds technical, but just think of it as a promise.
A promise.
It is a promise to pay investors back, but in a very specific sequence. And that payment is based on the cash flow that's collected from a big pool of assets.
Okay, pool of assets. That's the collateral part of the name, right? That's the C.
Correct. A CDO is essentially a box. You take a whole bunch of debt, and originally this was things like corporate debt, bank loans.
Safe stuff.
Relatively. But as we'll see, it eventually became completely dominated by mortgage-backed securities, or MBS. You put all these loans into the box. Those loans pay interest every month. That interest is the cash flow.
So if I'm an investor, I give you money, you put it in this box with a bunch of other people's money, you go out and buy 1,000 mortgages. And when those homeowners pay their bills, I get paid.
That is the basic idea, yes. But there's a crucial twist. If it were just a pool where everyone shared the risk equally, it would just be a mutual fund, basically.
Right.
A CDO is different. It's sliced into sections, and these sections are called tranches.
Tranches, that's the French word for slice, right? Like a slice of cake.
It is. And to understand why these exist, we have to use the analogy that comes up in almost every single explanation because it is just so accurate. We have to talk about the waterfall.
Ah, yes. The water flowing into cups analogy. I want to slow down here because this is really the mechanism. This is the piece of financial engineering that fooled everyone.
It absolutely is. So imagine the cash coming from all those mortgages, all those monthly payments is water.
Okay.
It flows out of the pool of loans and it hits a stack of cups. But the cups aren't side by side where they'd all fill up at the same time.
They're stacked vertically. one on top of the other.
Exactly. So you've got a top cup, a middle cup, and a bottom cup. And gravity does all the work. The water flows from the pipe and it goes into the top cup first.
Always the top cup.
Always. This represents the senior tranches. These are the investors who are first in line to get paid. Because they get the water first, they are the safest. Even if the flow of water slows down a little bit, say, a few homeowners stop paying their mortgages, the top cup will probably still get full.
So cup A, the top cup, is safe. It's boring. This is for, I don't know, grandma's pension fund.
Precisely. Because it's so safe, it pays the lowest interest rate. But, and this is key, it gets that coveted AAA rating from the credit agencies. It is the last to lose.
Okay, so my boring cup is full of water. What happens next?
Well, once that top cup is completely full, the water spills over the rim and starts to flow into the next cup down.
This would be the mezzanine tranches.
Right, the middle ground. These are rated anywhere from AA all the way down to BB. Now, these investors only get paid if the senior guys are fully satisfied, so they take on more risk.
Because if the water flow slows down a lot, it might run out before it ever reaches their cup.
Exactly. It might just trickle in or not get there at all. So because they're taking more risk, they demand a higher yield. They want more profit for that uncertainty.
Makes sense. And then at the very, very bottom of the stack,
You have the equity tranche.
the toxic waste.
Yeah.
Or the gold mine, I guess, depending on your perspective.
Both are accurate descriptions. It's sometimes called the residual or the first loss piece. This is the bottom cup. It only gets water if everyone above it is completely full.
So if the water flow slows down, even a tiny bit, if just a few percent of homeowners default, this cup stays bone dry.
You're wiped out. These investors get wiped out first. It's designed that way.
But there's always a but.
But if the water is flowing at full force, if everyone pays their mortgage on time, this bottom cup gets everything that's left over. And the upside can be uncapped. You could make 20-30% returns in a world where safe government bonds are paying 5%.
So theoretically, you've created a product for everyone. You have this super safe senior slice for the pension funds who are legally required to hold safe assets. You've got the middle slices for people with a bit more appetite for risk. And then you have the equity slice for the hedge funds who really want to gamble for those massive returns.
That is the theoretical brilliance of the CDO.
Yeah.
You take one big pool of loans, which might be a mix of good and bad, and by prioritizing the payments through this waterfall structure, you create a safe asset out of it.
You're not eliminating risk.
No, you're not eliminating it. You are slicing it up and selling it to the people who theoretically want to hold that specific amount of risk.
It sounds so logical when you say it like that. It sounds like it creates efficiency in the market,
It's supposed to.
but obviously got complicated. Let's talk about the cast of characters involved here, because it's not just a bank and an investor. It's a whole ecosystem of people. And they're all taking fees at every single step of the way.
It is a highly specialized assembly line, and
Right.
you have to understand all the players to see where things went wrong. First, you have the issuer.
Okay,
This is usually what's called a special purpose entity or an SPE.
a separate legal robot.
Essentially, yes.
Yeah.
The bank doesn't issue the CDO directly from its own balance sheet. They create a shell company, usually incorporated in the Cayman Islands.
I always see the Cayman Islands mentioned in these stories. Is that just because the bankers like the beach?
It would be a nice perk, but no. It's purely for tax neutrality and what's called bankruptcy remoteness.
Okay, break that down. Tax neutrality.
By setting up in the Caymans, the CDO avoids paying U.S. federal income tax on its global income. It's a pass-through vehicle. It makes it cleaner for global investors.
And bankruptcy remoteness.
That means if the parent bank, say, Merrill Lynch goes bankrupt, its creditors can't come after the assets inside the CDO. The CDO is legally separate. It's remote. It protects the CDO investors from the bank's problems.
And it protects the bank's balance sheet from the CDO's problems.
That's the idea. It holds the assets so the parent bank doesn't have to.
Okay, so we hear the Cayman robot. Who's actually running the show? Who's picking the loans?
That would be the asset manager. This is the person or the firm who is responsible for selecting the loans or the bonds that go into the box.
They're the stock pickers,
Well-
essentially.
They're the bond pickers, yeah. Their job is to manage a portfolio, and for that, they earn fees. They get senior fees, subordinated fees. They're supposed to be the experts, the ones picking the winners.
Supposed to be.
Yeah.
But, as we'll see later, they were often just picking whatever the bank told them to pick to get a deal done.
Or whatever was available, which became a huge problem. Next, you have the underwriter.
For the big investment bank.
Usually, yes. A Merrill Lynch, a Citigroup, a Bear Stearns. They are the architects. They structure the deal. They decide how big the slices are, what the interest rates will be, and most importantly, they sell those slices to investors. They are the salesmen.
And we can't forget the gatekeepers, the ones who made the alchemy seem official.
Yes. The rating agencies, Moody's, S&P, Fitch, they are absolutely critical to this entire process.
Why so critical?
Because they look at the tranches and they assign a grade. AAA for the top cup, AA for the next, all the way down to junk for the very bottom. Without their stamp of approval, especially that AAA stamp, the senior tranches could not be sold. Because many of the biggest investors, like pension funds and insurance companies, have rules. They are only allowed to buy assets that are rated AAA. So without that rating, the biggest pool of money in the world is off limits.
So the rating agencies held the keys to the kingdom.
They did. And finally, you have the trustee.
The trustee.
Yeah.
Sounds important.
They're basically the accountant, a bank usually. They hold the legal title to the assets in the pool, and they are the ones who run the waterfall models every month to figure out who gets paid what and in what order.
So that's the anatomy. It's a machine. A machine designed to process debt and spit out securities. But before it became this weapon of mass destruction, it was actually seen as a good thing, right? Let's get into the origin story.
Yeah, it wasn't always evil. In fact, the precursors to the CDO were actually government-sponsored programs. We have to go back to the 1970s.
Okay.
You have Ginnie Mae in 1970 and Freddie Mac in 1971. They created the very first mortgage-backed securities.
And the goal there was noble, right? It was to help liquidity in the housing market.
Exactly. The idea was if a local bank in Ohio can sell its mortgages to Ginnie Mae, it gets cash back immediately. And with that cash, it can then lend to more people to buy homes. It was all about expanding the American dream of homeownership.
It greased the wheels of the housing market.
It did. But of course, the private market wanted in on the action. In 1977, Salomon Brothers created the first private label MBS. It actually failed at first. It was a bit ahead of its time.
And this is when those famous names get involved.
Yes, you have legends like Louis Ranieri at Salomon Brothers and Larry Fink, who is now, of course, the head of BlackRock, the biggest asset manager in the world. They are credited with really inventing the business of securitization as we know it, pooling mortgages and slicing them up.
So when did the first official CDO with that name appear?
That showed up in 1987. It was issued by Drexel Burnham Lambert.
Oh, Michael Milken's firm. The junk bond kings.
It's the very same. They issued it for a bank called Imperial Savings Association.
1987. So this technology, this basic idea, was around for a full 20 years before the crisis. It wasn't some new invention in 2005.
Not at all. And through the 1990s and the early 2000s, we had what you might call the good CDO era. And the key word during this period was diversification.
Right. Because early on, they weren't just stuffing these things with mortgages from one place.
No, absolutely not. They were multi-sector CDOs. The collateral pools were incredibly diverse. They'd have aircraft lease debt in there.
So loans to airlines to buy planes.
Exactly. They had loans for manufactured housing. They had student loans, credit card debt, corporate bonds from all different industries.
And the theory, the sales pitch, was that all these things were uncorrelated.
Precisely. The safety theory was, if the airline industry crashes because of, say, a pandemic, people are probably still paying their student loans. If the manufacturing sector in the Midwest slows down, people in California are still using their credit cards.
One part of the economy might be weak, but the others will be strong.
Right. If one sector takes a hit, the others buoy the ship. Diversification was the primary selling point. And for investors, this was a fantastic deal.
Why?
Because these CDOs offered returns that were 2, sometimes 3 percentage points higher than regular corporate bonds, even though they had the exact same credit rating.
So I could buy a AAA-rated CDO tranche and get, say, 7% interest when a AAA-rated corporate bond from General Electric was only paying 5%.
Exactly that. It felt like a free lunch. The magic word on Wall Street, arbitrage.
A free lunch. But then something shifted. The machine went into overdrive. We enter the engine of growth. Why did these things explode in popularity? How did we go from this niche, diversified product to a global obsession that brought the system to its knees?
It comes down to 2 massive, powerful forces colliding at the same time: bank incentives and investor demand.
Okay, let's start with the banks. Why were they so utterly obsessed with making more and more CDOs?
It's all about capital requirements. Banks are regulated. They have to keep a certain amount of their own money capital in reserve against the loans they hold on their books.
As a cushion, in case things go bad.
As a cushion, exactly. So if a bank holds $1 billion in mortgages on its balance sheet, that ties up a lot of their capital.
Yes.
That's capital they can't use for anything else. But if they can securitize those loans, turn them into a CDO and sell them off, those loans are gone. They are off the books.
The capital's freed up.
It's totally freed up. They can immediately turn around and lend that same money out again to a new borrower. And every time they originate a loan, they get a fee.
So the whole model shifted.
Completely. It shifted from what was called originate to hold, where the bank makes a loan and holds it for 30 years, so they really care if you pay it back,
Right.
to originate to distribute.
Volume over quality. They didn't care if the borrower could pay the loan back in 30 years. They only care if they could sell that loan to a CDO manager next week.
It turned banks from vaults into pipelines. Just keep the product moving.
Okay, so that's the supply side. The banks are incentivized to create as much of this stuff as possible. What about the demand side? Who was buying all of this?
Well, you had this massive, massive wall of money that was sloshing around the globe looking for a home. Economists call it the global savings glut.
A glut of savings.
Yeah. Between the year 2000 and 2007, global fixed income investments, that's the bond market, doubled. It went to $70 trillion.
$70 trillion. That is a staggering amount of money. Where was it all coming from?
It was coming from everywhere. You had emerging market economies, especially China, running huge trade surpluses. They were selling us goods and getting paid in dollars, and they had to invest those dollars somewhere.
Okay.
You had oil-producing nations in the Middle East that were just flush with cash as oil prices skyrocketed. All of this money needed a safe place to go to earn interest.
But U.S. Treasury bonds, the safest investment in the world, were paying peanuts at the time.
Exactly. You have to remember the context. This is the period after the dot-com bubble burst. It's after 9/11. The Federal Reserve, under Alan Greenspan, had slashed interest rates to historic lows to stimulate the economy.
So investors were desperate.
They were desperate for yield. They needed profit. And at the same time, they were scared. They'd just been burned by the stock market crash, so they also wanted safety. They wanted that AAA rating.
So you have this paradox. I want high returns, but I also want zero risk.
Which is impossible, usually. But the CDO seemed to be the perfect solution. It offered the yield of a riskier asset. Remember, it pays better than regular bonds. But it had that AAA stamp of safety from Moody's or S&P.
It looked like a safe treasury bond, but it paid like a much riskier corporate bond.
It was the perfect product for that exact moment in time. And that insane global demand drove the machine. Wall Street had to feed the beast. But then they hit a problem, a supply problem.
This is where the story turns. This is the big shift to subprime. Because eventually, you just run out of good collateral, you run out of aircraft leases and high-quality corporate debt.
You do. By 2003, 2004, the supply of prime mortgages and diverse loans was basically exhausted. But the investors, the Chinese sovereign wealth funds, the German pension funds, they were still screaming for more CDOs. So the bankers on Wall Street started to substitute the collateral.
They started using subprime mortgages.
Correct. The assets inside the box changed. The recipe changed. By 2004, mortgage-backed securities already accounted for more than half of all CDO collateral. By late 2005, some of these portfolios were 85% subprime mortgages.
So the diversification, that whole safety net we talked about earlier, was just gone.
It evaporated. It was all betting on one thing and one thing only: the U.S. housing market.
Well, wait, this is the part that always gets me. If you fill a box with really risky subprime loans, how do you still get a AAA rating on the top slice? I mean, if I fill a box with dynamite, I can't write safe on the lid just because I packed it really tight.
This is the alchemy. This is the magic trick. And it involves a very specific mechanism called mezzanine recycling. This is arguably the single most important concept to understand, and it's the one that usually gets skipped over in the movies.
Okay, let's break this down slowly.
Yeah.
Mezzanine recycling.
Ah!
This sounds like some eco-friendly initiative at the office, but I have a feeling it's not.
Far from it. Okay, so think about a regular mortgage-backed security, an MBS. Not even a CDO yet, just a plain vanilla pool of mortgages.
Okay.
When you slice up that pool of mortgages, it's actually pretty easy to sell the top AAA slice. Everyone wants that safety.
Right.
It's also surprisingly easy to sell the bottom super risky equity slice because hedge funds love the gamble, they love the high potential return.
But the middle, What about the slices in the middle?
The mezzanine slices, the stuff that's rated, say, a BBB. It's the unloved middle child of the capital structure.
Yeah.
It's too risky for the conservative pension funds. Their rules say they aren't allowed to buy it. But the yield isn't high enough for the aggressive hedge funds. They can't be bothered with it for, 8% return when they're looking for 30%.
So Wall Street had this glut. They had a problem where these BBB-rated mortgage bonds were just piling up in their warehouses.
Exactly. It was a log jam in the system. And if you can't sell the middle part of the deal, you can't do the deal at all. The entire assembly line was jamming up.
So what did they do?
They got creative. They gathered up all these unwanted BBB-rated mortgage bonds from dozens of different deals, and they put them into a brand new CDO.
A CDO made entirely of the leftovers, of the stuff nobody else wanted.
Entirely. It's what was sometimes called a CDO squared, because it was a derivative of a derivative. But here's the magic. They applied that same waterfall logic to this new pool of junk.
Even though it was all junk.
Even though it was all junk. They said, okay, even though these are all BBB-rated bonds, surely they won't all default at the exact same time. They're from different parts of the country. A default in Florida doesn't automatically mean a default in Ohio.
So they took this pool of leftovers and they sliced it up again.
Yes. They created a new senior tranche on top of this pool of BBB-rated bonds. And the rating agencies, they looked at that new structure, ran their models, and they said,
That's AAA.
correct.
That is just, it's insane. You take a pile of BBB bonds stuff that was explicitly defined as medium risk that nobody wanted, you put them in a box, and then you claim that 70 or 80% of that box is now the safest investment on earth.
That is exactly what happened. It was called ratings arbitrage. Gretchen Morgenson, a fantastic journalist who covered this, called it turning dross into gold. They were literally manufacturing AAA assets out of subprime risk.
And this is where the math has to come in, right?
Yeah.
Because they couldn't just do this on a whim. They had to have a model, a formula to justify this to investors, to regulators. You can't just wave a wand and say it's safe. You need a spreadsheet.
And they had one. Enter David X. Lee. In 2001, he published a paper introducing the Gaussian copula model.
That sounds like something out of a sci-fi movie. The Gaussian copula.
It was, in its field, a massive statistical breakthrough. Before this model, pricing these complex correlations, trying to figure out how likely it was that two different loans would default at the same time, was incredibly difficult and slow. It took massive computing power.
And Lia's formula simplified it.
Drastically. It used a single elegant parameter, the price of a credit default swap, a CDS, as a proxy for the correlation between any two assets. It made the math clean. It allowed banks to price and structure these complex CDOs with incredible speed. It became the industry standard almost overnight.
The traders must have loved it.
They adored it. They could value a complex deal in minutes instead of days.
But there was a flaw in the model, a fatal flaw.
A huge one. The model, like all financial models, relied heavily on historical data to predict correlation. And here is where we need to talk about the difference between a house fire and a forest fire.
I love this analogy. Let's walk through it.
Okay. If I'm an insurance company and I insure your house against fire, the risk is unique to you. It's uncorrelated. Just because your kitchen catches fire doesn't mean your neighbor's kitchen will suddenly catch fire.
Right. So it's safe for the insurance company to insure the whole neighborhood because the odds of every single house burning down at the same time are practically zero.
Unless there is a forest fire.
An external systemic event, a strong wind, a drought.
The Gaussian copula assumed that mortgage defaults were like individual kitchen fires. It assumed that housing markets in different cities were largely independent of each other. It looked at all the historical data and said, we have never had a nationwide decline in U.S. housing prices, not since the Great Depression.
It assumed the forest fire was impossible.
Exactly. But when lending standards collapsed nationwide and when teaser interest rates all reset higher at the same time, nationwide, correlation went to 1. It was a forest fire. Everyone defaulted at once. And the model just couldn't handle that scenario. It wasn't programmed for it.
Okay, but what about the rating agencies? Why didn't they catch this? Why were they handing out AAAs like candy if the model was so obviously fragile? This was their only job.
Well, this is where it gets really ugly. It's about the conflicts of interest. We have to look at the fee structure. The rating agencies, Moody's, S&P, Fitch, they are paid by the issuers.
So they're paid by the banks creating the CDOs.
Yes. So if I'm a bank and I want my brand new CDO to be rated, I go to Moody's and I pay them a fee. And if Moody's looks at my deal and says, this is only worth a AA.
I just take my business down the street to S&P and see if they'll give me the AAA I want.
And if they do, they get the fee. It was a race to the bottom, and it was an incredibly profitable business. At its peak, Moody's structured finance division, the part that rated these CDOs, accounted for 44% of all their sales. Their profit margins were over 50%.
That's higher than Exxon or Microsoft at the time?
It was one of the most profitable businesses on the planet, so they had zero incentive to be tough. In fact, they had every incentive to look the other way, to be flexible with their models. If they started saying no to the banks, they would lose market share and their stock price would fall.
Joseph Stiglitz, the Nobel-winning economist, he later blamed them for performing alchemy. He said they converted F-rated risk into A-rated paper.
That's a perfect summary. And what happened was investors, even sophisticated ones, they stopped doing their own homework. They just bought the rating, they saw the AAA stamp, and bought it blindly. They completely outsourced their due diligence to the very agencies that were being paid by the people selling the product.
It seems like we have all the ingredients for a complete disaster. We've got bad loans, a flawed structure, broken models, and conflicted referees. But wait, there's more. We haven't even talked about synthetics yet. This is where it goes from a bad idea to total insanity.
Synthetic CDOs.
Yeah.
This is where we really leave the realm of actual lending and we enter the realm of pure betting.
So what is the fundamental difference between a cash CDO and a synthetic one?
A cash CDO owns actual things. It goes out and buys real bonds, which are backed by real mortgages on real houses owned by real people. You buy a cash CDO, you are, in a very indirect way, funding a homeowner's loan.
Okay, and a synthetic.
A synthetic CDO doesn't own anything. It doesn't buy a single bond. It just references those bonds. And it does this using credit default swaps, or CDS.
Okay, how does that work in simple terms?
A CDS is basically an insurance contract. Let's say I'm an investor and I sell you a CDS on a particular mortgage bond. I'm selling you insurance. I am betting that bond will not default.
Okay.
In exchange for taking that risk, you pay me a premium, like an insurance premium, every quarter. If the bond pays out fine, I just collect the premiums and I'm happy. If the bond defaults, I have to pay you the full face value of the bond.
So in a synthetic CDO, the assets aren't bonds. The assets are these insurance bets.
Exactly. The investors are selling insurance, betting the bonds won't default, and the cash flow is the premiums they collect. And here's why that distinction is so unbelievably important.
Go on.
In the real world, there is a limit. There is a finite number of bad mortgages that exist in America. There are only so many subprime borrowers. You can only package the actual loans once in a cash CDO.
But with synthetics.
There is no limit. You can create 1,000 different synthetic CDOs all referencing the exact same pool of bad mortgages.
It's like fantasy football. There's only one Patrick Mahomes. But you could have a million different fantasy leagues where people are all betting on his performance. If he breaks his leg, the Chiefs only lose one quarterback, but a million fantasy owners lose their bet.
That is the perfect analogy. It allowed the amount of money moving in the system, the amount of risk, to vastly, vastly exceed the actual value of the underlying real estate market. It multiplied the risk exponentially.
And it was faster and cheaper to create, right?
Yeah.
You didn't have to go out and actually find real borrowers and originate real loans.
Much faster. You could create these things out of thin air in a conference room in an afternoon. You didn't need to wait for a bank in California to make a loan. You just needed two guys on Wall Street willing to take opposite sides of a bet. And as the supply of actual subprime borrowers started to dry up, synthetics took over to keep the fee machine running.
Okay, so we have the broken structure, the bad incentives, the flawed math, and now the infinite multiplier of synthetics. Now comes the crash.
The year is 2006. Housing prices, which had been on this incredible tear, they peak. They level off, and in some places they start to fall. The engine is starting to sputter.
And we start hearing these incredible stories about the underwriting standards. I mean, the warning signs were there for anyone who bothered to look.
Oh, they were everywhere. Michael Lewis tells the famous anecdote in his book of the Mexican strawberry picker in Bakersfield, California. An individual with a stated income of $14,000 a year, who didn't speak a word of English, was lent $724,000 to buy a house.
And I'm guessing that was with a teaser rate.
Of course it was. A 228 or a 327 adjustable rate mortgage. You get a very low affordable payment for 2 or 3 years. But when those 2 years are up, the rate resets to a much higher level. The monthly payment skyrockets.
And in a normal market, you would just refinance into a new loan.
But you couldn't, because house prices were now falling. Your house was worth less than your loan. You were trapped.
So the defaults start, and if we go back to our water analogy, the water stops flowing.
The flow slows to a trickle, and then it stops. The bottom cups, the equity tranches, they dry up immediately. Then the mezzanine cups. But because of that mezzanine recycling we talked about, where the senior tranches of many CDOs were actually made of mezzanine risk from other deals, the top cups, the safe AAA cups, started to dry up too.
The turning point, the moment the market really woke up, seems to be the summer of 2007.
July 2007. Two hedge funds run by the investment bank Bear Stearns completely collapsed. They were highly leveraged in subprime CDOs. They sent a letter to their investors telling them they would get little to nothing back on their investment. That was the tremor before the earthquake.
And then the downgrade started. The referees finally changed the call.
It was an avalanche. It was too little, too late. In the first quarter of 2008 alone, the rating agencies announced 4,485 downgrades of mortgage securities.
4,000 in 3 months.
Think about that number. 4,485 securities that were sold as safe investments suddenly weren't.
It's the forest fire.
It's the forest fire, and the numbers are just shocking. By 2009, more than half of all the AAA-rated CDO tranches that were issued between 2005 and 2007 were either downgraded to junk status or had already lost principal. That's $300 billion of safe money just gone.
There's that famous line from the Big Short movie. They describe CDOs as, how can we say it, dog shit wrapped in cat shit.
It's a graphic description, but by the end, it was an accurate one for how the product had evolved. It was toxic waste, wrapped in more toxic waste, and sold with a gold-plated bow on top.
So the system collapses, banks fail, the government steps in with bailouts. But I want to talk about the aftermath, the blame game.
Yeah.
Because it wasn't just that a bunch of investors lost money, it was the systemic impact of these things.
They were the engine. The Financial Crisis Inquiry Report makes this very clear. Without the CDO machine, lenders would not have pushed subprime loans so aggressively. They only made those bad loans because they knew there was a buyer. They knew they could sell them to the CDO machine. The demand for the securities created the supply of the bad loans.
And the whole idea of dispersing risk turned out to be a fantasy. We didn't disperse it, we concentrated it.
Exactly. The risk didn't disappear, it just got hidden. And where did it end up? It ended up right back on the balance sheets of the biggest banks and insurance companies in the world. People like AIG, Citigroup, Merrill Lynch.
Why did they end up holding it?
Because they would often hold on to the super senior tranches, the absolute safest, top of the waterfall slice. They thought it was basically risk-free, and they could earn a tiny bit of extra yield by keeping it for themselves instead of selling it. When those supposedly risk-free tranches failed, the institutions themselves failed. They choked on their own cooking.
We have to mention some of the specific villains, or at least the specific examples of excess that came out in the investigations. Because there are stories here that sound completely illegal, even if they were technically just business.
The story of Magnetar is probably the most damning. They were a hedge fund out of Illinois. They figured out early on that the market was going to crash. But instead of just shorting the market, they actively helped create more bad CDOs just so they could bet against them.
This is the infamous Norma CDO.
That's the one. They worked with Merrill Lynch to create a CDO called Norma. Magnetar helped select the assets that went into it, and guess what? They picked the absolute worst, most toxic stuff they could find. One consultant called it a hairball of risk.
So they built a bomb, helped Merrill Lynch sell it to unwitting investors as a safe house, and then they went and took out a massive insurance policy on the house blowing up.
That is exactly what they did. They would buy the riskiest equity slice, the bottom cup, just to get the deal off the ground. That would cost them a little money. But then they would take out huge bets against the upper slices of the deal using credit default swaps. When the whole thing inevitably blew up, their small loss on the equity was dwarfed by their massive gains on the shorts.
And Goldman Sachs had a similar situation with their Abacus CDO deal.
Right. That led to the 2010 settlement with the SEC. They paid $500 million. They were accused of not disclosing to the investors who bought the Abacus CDO that a famous hedge fund, Paulson & Co., had not only helped select the assets, but was also simultaneously making a massive bet that it would fail.
It really paints this picture of a rigged game. It wasn't just bad luck or a flawed model. In some cases, it was engineered failure.
It does. Patrick Parkinson, who is a senior official at the Fed, later called the whole concept of these subprime-backed CDOs, these EBS CDOs, an abomination. It wasn't just a bad trade. It was a structurally flawed concept from the beginning. It relied entirely on the one assumption that could never break, that house prices never go down.
And yet people made fortunes.
And many of them kept those fortunes.
So as we wrap this whole thing up, what's the big takeaway? If you're listening to this in 2026, Why should you care about the intricate mechanics of a CDO from 2 decades ago?
The takeaway, for me, is about complexity. The CDO started as a genuinely useful tool for diversification, a way to fund aircraft and student loans. But complexity became a hiding place,
A way to hide risk.
a way to hide risk, and a way to generate fees. The waterfall structure, the mathematical models, it all looks so sophisticated. But it only protected the senior investors as long as defaults were low and uncorrelated. The incentives, the origination fees for banks, the desperate search for yield by investors, the ratings fees for the agencies drove everyone to stop checking the engine. They just trusted the AAA sticker on the bumper.
It's that old reminder. If you don't understand it, you probably shouldn't buy it. And if the person selling it to you relies entirely on a model they can't explain without a PhD in physics, you should probably run.
And remember the human element in all of this. These weren't faceless machines destroying the world. It was people. People at every level who convinced themselves that house prices never go down.
Wrong.
People who didn't want the music to stop because they were making too much money. It was a mass, collective, willful blindness.
So here's a final provocative thought for you to chew on. We've just spent this time looking at how CDOs turned into these monsters. But financial engineering didn't die in 2008.
No, it didn't. Wall Street never sleeps. It just rebrands.
Today, we have things called structured operating companies. We have a boom in new forms of securitization in private credit. We have CLOs, collateralized loan obligations, which are booming and look eerily similar to CDOs, but are backed by corporate loans instead of mortgages. We changed the acronyms. But have we actually fixed the underlying incentive problem?
That is the multi-trillion-dollar question. Does financial complexity, in the end, actually create risk rather than dispersing it? By trying to engineer perfect safety, do we just end up building a bigger, more complicated bomb? Are we just inventing new ways to hide the same old human greed and fear?
Something to think about next time you see a product that promises a guaranteed high return. Thanks for listening to The Deep Dive.
Stay curious.